You are past the initial phase. You are no longer guessing. You can read a chart. You understand risk management principles. You know what a high-probability setup looks like. You have a system, a robust, back-tested edge that should mathematically be working. But here is the silent killer. You are still losing. Or worse, you are stuck in the purgatory of break-even. Your equity curve looks like a flat horizon line, occasionally spiking up, only to crash back down, wiping out weeks of disciplined effort in a single, reckless afternoon. You are sitting on the intermediate plateau. The deepest frustration is that you know exactly what you did wrong. It wasn't the market that beat you, it was you. You saw the signal, you hesitated, you entered too late, you moved your stop loss, you chased a move driven by fear of missing out. You executed the trade perfectly, only to exit early, driven by fear of giving back paper profit. You are the only variable that consistently breaks your own system. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. Stop pretending the market is the enemy. The market doesn't care about your system. It doesn't care about your rules. It is impersonal, yet you take every single loss personally. When a trade goes against you, you feel insulted. Your ego demands retribution. This is the moment you transition from being a systematic trader to being a gambler seeking revenge. You are demanding that the market validate your intelligence and reward your effort. But the market is not designed to reward effort. It is designed to reward disciplined exposure to volatility. This gap, the terrifying chasm between your analytical skill and your emotional discipline, is the hidden stage. You possess the map, but you keep setting the compass wrong, guided by internal pressures you refuse to acknowledge. You are technically competent, yet emotionally bankrupt. You understand the math of expectancy, but you cannot execute the patience of waiting. You know how to let winners run, yet you snatch small profits because the uncertainty of holding feels like a threat to your survival. Your profit and loss is merely a reflection of your internal chaos. You feel trapped because you are demanding control over the uncontrollable. You are demanding certainty from an environment defined by uncertainty. This single, toxic demand is the true barrier to your success. It is the reason your equity curve remains chained to the zero line despite all your study. I am going to tell you the single, most destructive psychological demand you are making of the market right now. A demand so deep, so ingrained, you don't even realize you are making it. It is the real reason your profit and loss is flatlining. That demand, the silent killer of accounts, is this: the expectation that the next trade must work because your analysis is sound. You confuse high probability with guaranteed outcome. You believe that because you spent 3 hours analyzing the divergence, because the setup fits your checklist perfectly, the market is somehow obligated to deliver the result you want. This is the demand for certainty in an environment built on pure, chaotic uncertainty. Understand the fundamental truth of trading. You do not have an edge on any single trade. You only have an edge across 1,000 trades. Your strategy might have a 60% win rate, but that statistic means absolutely nothing for the trade you are currently in. That single event is statistically random. It is no more likely to succeed than the previous one failed. The moment you enter the position, your analysis dissolves into the current flow of institutional liquidity and pure chance. You are relying on the law of large numbers, but your ego insists on controlling the very next number. This internal conflict, the statistical reality versus the psychological need for immediate validation, is the engine of self-sabotage. How does this demand for certainty manifest in your execution? It poisons every decision. Because you demand the trade works, you oversize the position. You are not betting a manageable amount. You are leveraging the expectation of a guaranteed win. When the price moves against you, you panic, because guaranteed things are not supposed to move against you. You move your stop loss, turning a statistical outlier into a catastrophic loss because you are convinced the market must respect your homework. Conversely, when the trade moves favorably, you snatch the money off the table prematurely, a premature profit take, because you need the validation of a win now. before the market can expose the lie that your analysis was anything less than perfect. You are prioritizing the emotional certainty of a small win over the statistical requirement of letting your winners run. You are not managing risk. You are managing your ego's insistence on being right. The moment you demand certainty from an uncertain environment, you are no longer trading the market. You are trading your fantasy. You are trading the version of reality where effort guarantees reward, where intelligence shields you from randomness. This is the deep, fundamental lie you must excavate. You are attempting to impose order on chaos, and the market, in its infinite indifference, will always shatter that imposition. The market does not care how much homework you did. It does not care about your conviction. It does not care about the hours you spent studying volume or reading the latest economic reports. The market only cares about price, and price is the result of countless anonymous decisions. Your demand for certainty is the heavy chain around your neck, dragging you down into the cycle of revenge trading and positional anxiety. To find freedom in trading, you must first find freedom from the need to be right on the very next trade. You must learn the art of surrender. But how do you surrender control when the stakes are real money? How do you maintain discipline when you actively embrace the fact that your next trade is probably going to be a loser? That is the next step in this psychological journey. The answer lies in understanding the true cost of your ego. The reason you struggle to surrender control is that deep down, you have fused your self-worth with your trading results. Every losing trade, every small stop-loss that gets hit, is not processed as a statistical event. It is processed as a personal attack. It feels like the market is judging you. It feels like the market is saying, "You are not smart enough." And that judgment, that perceived moral failing, is the single deepest psychological barrier to success. Think about the last time you took a significant loss. Was the initial pain really about the money? Or was it the visceral feeling of being wrong? The intermediate trader is often highly intelligent, highly analytical. You solve complex problems for a living. And when the market humbles you, your ego steps in to protect that identity. It screams, "I know better than this chart. I deserve this profit." This is the moment when discipline collapses. You are no longer trading the chart. You are fighting the chart. You are fighting for your pride. And the market, being infinitely patient, will always win that fight. The ego's most expensive defense mechanism is its refusal to admit error. Taking a small planned loss requires a moment of genuine humility. It requires you to look at the screen and say, "My analysis was incorrect, and I accept the cost of that mistake." Your ego refuses to sign that check. It prefers the illusion of control. It whispers, "Just hold it a little longer. It will come back. You'll prove them all wrong." And so, you hold a position that breaches every rule you set for yourself, turning a manageable 1% risk into a 5, 10, or even 20% catastrophe. How much has your need to be right truly cost you, not just in capital, but in sleepless nights and eroded confidence? The market doesn't care about your intelligence. It has no opinion on whether you are right or wrong. It is simply a mechanism for transferring wealth from the impatient to the patient, and from the emotional to the mechanical. When you look at the screen and feel that surge of panic or shame, you are not seeing the market. You are seeing a mirror reflecting your own internal need for validation. The moment you see a loss as evidence of your stupidity, you have already lost the game. The professional trader understands that losses are not judgments. They are simply the necessary cost of doing business, like rent or utilities. They are predictive data points, nothing more, nothing less. Your job is not to avoid losses. Your job is to manage the size and frequency of those losses. The journey toward becoming a truly mechanical and resilient executor is never complete. It requires a constant refinement of self-awareness and an enduring philosophical anchor to withstand the inevitable periods of drawdown and doubt. The definitive guide to achieving this inner fortress is Marcus Aurelius's Meditations. This new, highly accessible 2025 translation is stripped of academic obfuscation, speaking directly to the modern leader and thinker seeking calm leadership and emotional intelligence. For those ready to commit to the ongoing mastery of their psychological landscape, we have secured a link to this essential edition in the description below. Ensure you possess this map for sustained clarity and fortitude. The great separation must occur here. You are not your profit and loss statement. Your intelligence is not determined by whether the next candlestick closes red or green. Success in this domain requires psychological surgery, the careful excision of your self-worth from the outcome of any single trade. When you can take a small loss without feeling the sting of personal defeat, when you can execute your stop-loss order with the same cold, detached precision as you execute a limit order, you have achieved the first level of mastery. You have stopped trading your bank account and started trading your plan. The paradox is this: to gain control over your trading results, you must first surrender control over the need for any single trade to validate your existence. But this surrender is not passive resignation. It demands a higher form of discipline, the discipline of execution, regardless of feeling. That is where true mechanical edge is found, and that is what we must examine next. But the discipline of execution is only half the battle. The other half is the discipline of inaction. This is the psychological barrier that stops nearly every intermediate trader dead in their tracks: the addiction to action. You believe you lack the discipline to follow your rules, but the truth is deeper. You lack the patience to tolerate the gap between your desire for profit and the market's willingness to deliver a high-probability setup. You are addicted to the process of trading, not the process of winning. Think about what happens when you sit down at your screen. You feel a primal pressure to do something. If the charts are quiet, if the setup is not yet mature, a gnawing discomfort sets in. This is not financial pressure. This is biological. This is the brain demanding the dopamine hit that comes from decision-making, from the thrill of placing an order, from the immediate rush of risk exposure. Successful trading is inherently boring. It requires the repetitive execution of an obvious edge. Your brain, however, is not wired for boring repetition. It is wired for survival and novelty. It interprets the stillness of waiting as inefficiency, as a threat to your potential profit and loss statement. So you force a trade. You take a mediocre setup. Why? To alleviate the psychological discomfort of silence. You are paying the market for entertainment. If you are trading for income, you wait for the trade to come to you. If you are trading for entertainment, you chase the trade. The moment you enter the market prematurely, you have signaled to yourself that the satisfaction derived from the act of trading is more important than the statistical integrity of your capital. We often talk about the fear of missing out, or fear of missing out. But let's deconstruct what that fear truly is. It is not the fear of missing profit. It is the ego's fear of irrelevance. When the market moves without you, your ego feels dismissed. It demands participation. It screams, "I am a trader. I must be involved in this movement." This impatience, this demand for relevance, overrides your statistical analysis and forces you to enter positions that defy your established criteria. You are trading to soothe your ego, not to grow your account. You must understand this. The market does not reward activity. It rewards stillness. The best trades require long periods of observation and profound patience. The highest profit factor setups often appear only after hours of waiting, when the biological urge to quit or force a trade is at its absolute peak. The market is designed specifically to exploit this biological weakness, your need for action. Every time you place a low-probability trade, you reinforce the neural pathway that links action with reward, even if the reward is only the momentary stress relief of having done something. You are training yourself to be an action junkie. You have turned the market into a slot machine where the pull of the lever is the reward, regardless of the payout. How do you break this cycle? You cannot fight a deep biological addiction through willpower alone. That is like trying to stop a flood with a teaspoon. The desire for action is too strong, too deeply rooted in your need for immediate relevance. The solution is paradoxical. You must replace the addiction. You must shift the focus from the outcome, the profit, the excitement, to the process itself. The only way to achieve true mechanical edge is to become addicted not to the outcome of the trade, but to the perfect execution of your system. You must become a fanatic for following your rules, regardless of whether the trade wins or loses. This addiction to perfect process is the only force strong enough to overcome the biological compulsion for premature action. We must now define exactly what that perfect process entails, step by step, to give your mind a new, higher form of discipline to chase. The perfect process begins with the ultimate psychological paradox, the surrender. Most intermediate traders hear the word surrender and immediately associate it with weakness, with giving up. But in trading, surrender is the ultimate act of strength. It is the radical upfront acceptance of the risk defined by your stop loss before you ever click the button. You are surrendering control over the immediate outcome. You are declaring that the only thing you can control, your execution, is the only thing that matters. Why fight the market? The market does not care how much money you need to make this month. It only cares about the forces of supply and demand. Your fight is misplaced. Stop fighting the chart and start fighting the impulse to deviate from your own rules. Think about the moment you enter a position. What is your primary focus? Is it the potential profit and loss? Is it the quick rush of being right? If it is, you have already failed the test. The successful trader enters the market having already accepted the maximum allowable loss. That capital is psychologically gone the instant the trade is live. This is the difference between hoping and executing. Hope is an emotion that destroys systems. Execution is a logical commitment to a quantifiable edge. Your only job after entry is simple. Did I follow my checklist? Did the entry criteria align perfectly? Was the position size correct? If the answer is yes, then the loss is irrelevant. It is simply the cost of doing business. But if the answer is no, even if the trade wins, that win is catastrophic. That is the deepest psychological barrier we must dismantle. The notion that a winning trade equals success. The market is cruel enough to reward bad behavior just long enough to cement a terrible habit. When you skip a rule, take too much risk, but still make money, you have reinforced indiscipline. That is not success. That is a ticking time bomb disguised as profit and loss. Success is not measured by the dollar amount of your account today. Success is measured by the perfect execution of your defined strategy, trade after trade, month after month. The money is merely a lagging indicator of your discipline. It is a reward for your unwavering commitment to the process. You are not paid to be a predictor. You are paid to be an executor. Internalize that statement. The moment you define success as perfect execution, you unlock a profound emotional release. The fear of losing money shrinks dramatically because the objective has changed. You are no longer chasing dollars. You are chasing perfection on your checklist. You are chasing the satisfaction of knowing that, regardless of the outcome, you did your job exactly right. This shift transfers your focus from the unpredictable outcome to the controllable process. It allows you to treat the market like a laboratory, where every trade is a controlled experiment designed to test your edge, not your ego. This is how consistency is built, through mundane, repetitive, flawless execution. But how do we build a checklist robust enough and specific enough to withstand the inevitable temptations of greed and fear? How do we quantify the rules so clearly that deviation becomes impossible? The quantification begins not on the chart, but in the silence before the trigger is pulled. The answer to resisting temptation is not willpower. It is pre-commitment. You must externalize the contract you make with yourself before the market has a chance to flood your system with adrenaline. This is a non-negotiable ritual that separates the professional from the gambler. Before you click the entry button, you must verbally state your parameters. Not think them, not type them silently into a note. You must hear your own voice say them. Speak the contract into existence. I am entering here based on criteria X. My maximum risk is Y. My stop loss is placed at this specific price level. I will take profit at that specific zone. This simple act, this 3-second verbalization, forces the chaotic, emotional brain to adhere to the rational, planning brain. It transforms the trade from a hopeful gamble into a mechanical execution of a predefined plan. The psychological weight of the spoken word is profound. It removes the agonizing, destructive decision-making that happens mid-trade when fear spikes and uncertainty clouds your judgment. You have already decided. Your job now is simply to watch the execution unfold. This structure is reinforced by micro-commitments. You must establish a setup rubric, perhaps a scoring system from 1 to 10, based on the confluence of your indicators, market structure, and timing. You are not allowed to take any trade that scores less than an 8 out of 10. This isn't about perfection. This is about psychological leverage. Every time you reject a 7 out of 10 setup, you are actively choosing discipline over impulse. You are depositing trust back into your own psychological account, an account that has likely been drained by months of impulsive, low-probability trades. The true work, however, is done after the trade is closed, regardless of the outcome. Most traders review their profit and loss statement. They obsess over the money made or lost. This is meaningless noise, a distraction from the core problem. Your post-trade review must focus exclusively on the decision-making process. Was the entry flawless according to the 8 out of 10 rubric? Did you respect your stop-loss without moving it? Did you adhere to your take-profit target, even if the market ran further? The deepest level of internal discipline requires you to journal the feeling that preceded any deviation. Did you chase the move because of the sickening feeling of fear of missing out? Were you bored? And did you enter a low-probability trade simply to alleviate the anxiety of sitting still? Did impatience cause you to prematurely exit a winning position because the pressure of holding a floating profit became too great? You must be painfully honest about the emotional catalyst, not just the statistical result. Write down the internal dialogue. I felt a massive surge of greed when price broke that level, and I ignored my own rule because I was afraid of being left behind. The money is a distraction. The feeling is the signal. That feeling is the raw, exposed weakness that the market will exploit every single time until you face it. Finally, we must master the discipline of inaction. The most profitable thing you will ever do is sit on your hands. It is the silent, stoic strength required to wait for the high-probability opportunity. If your setup does not score an 8, you are paid to do nothing. You are paid to protect your capital and your mental bandwidth. This internal structure, the verbal contract, the micro-commitments, and the brutal post-mortem focused purely on feeling, is how you forge a consistent trading identity. But what happens when this structure is tested not by a single bad trade, but by an extended, inescapable period of painful drawdown? How do you maintain mechanical execution when the market has taken everything you put in? The true integration point is when that pain stops registering. It is the moment you realize that the market's action is entirely separate from your identity. You will find that the painful drawdown, which once felt like a personal attack, now feels like weather. Unpleasant maybe, but utterly impersonal. This is the hallmark of the unburdened trader. You are not celebrating a win, nor are you cursing a loss. There is a profound, almost unsettling neutrality. You execute the trade entry, the stop loss, and the take profit with the same quiet attention you would give to tying your shoes. The emotional charge has been fully diffused. When you achieve this state, you stop trying to force the market to validate your intelligence. You stop needing the rush. This neutrality is the secret they don't teach you. Consistency is not exciting. It is profoundly boring. If you seek the adrenaline rush, you are still trading for psychological compensation, not for robust profit. The successful trader is the technician who has removed the self from the equation. The noise of the market, the talking heads, the flashing screens, the urgent price action, it all begins to fade into a dull hum. Why? Because the noise that mattered wasn't external, it was the incessant internal dialogue demanding certainty and validation. When you silence the ego, the market loses its power to distract you. You stop trying to predict the future and start focusing only on the present decision. Does this setup meet my written criteria? Yes or no? Nothing else. This shift is not merely mental, it is physiological. The anxiety that used to knot your stomach when you click the mouse vanishes. It is replaced by the calm awareness that you are simply executing a proven, positive expectancy edge. You are playing the long game, and the results of this single, isolated trade are statistically meaningless. The peace that descends upon the integrated trader is the peace of acceptance. The single, deepest psychological barrier to success is the refusal to accept the reality of randomness. We are wired to find patterns, to impose order, to believe that our effort must guarantee a specific outcome. But trading is a purely probabilistic endeavor. The moment you truly surrender the need for certainty on this trade, you unlock the ability to be profitable over the next 100 trades. You stop fighting the fundamental nature of the game. That surrender is not defeat, it is the ultimate victory over the ego. The market is just a mechanism for transferring wealth from the impatient to the patient, from the emotional to the mechanical. You become a conduit for your edge, not a participant in the emotional drama. Now, the work is simple, but it is not easy. Go back to your charts today, not to find the next perfect entry. Go back to find the next moment where your ego tries to demand certainty, where it tries to convince you to override your rules, or where it suggests that this time the loss won't happen, and shut it down. Observe that voice. It is the last ghost of the old, unprofitable you. You must starve it of attention. The real power is not in identifying the perfect setup, but in perfectly executing the imperfect reality. But what happens when the market itself shifts, when your proven edge suddenly stops working for 6 months straight? How do you maintain faith in a system that seems fundamentally broken? If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain.